Welcome back to the Deep Dive. Today, we're tackling something pretty interesting, getting right into the heart of decentralized finance and, well, digital banking.
Yeah, we're dissecting this framework. From Marshall Hayner, the CEO of Metallicus.
Exactly. We've got sources here defining what he calls the 5 pillars, these foundational assets.
And the idea is they combine to create a complete financial stack, fully compliant too, which is key.
Right. This isn't just listing features. It's more about understanding the blueprint, isn't it?
It is. It's about bridging that gap, between blockchain speed and transparency.
And the security and, frankly, the regulatory demands of traditional finance. So for you listening, the mission is a quick but solid grasp of these 5 things: XMD, MTL, Metal XPR, and loan. And crucially, how they work together, right? Not just as separate tokens, but as a unified system.
A unified monetary system, that's the claim.
Okay, let's unpack this then.
Yeah.
Where do we start? Foundational level.
Yeah, let's start there. The infrastructure, the stuff that handles movement and, like you said, compliance. You have to get that right first.
Especially if you're aiming for regulated players.
Exactly. You can't just grab any blockchain. You need something purpose-built, something that guarantees security, sovereignty, and compliance. Which leads us straight to pillar 3, Metal, the layer 0 engine. The sources are clear. US-built layer 0 architecture, L0. Why is that important again? Well, layer 0 is like the absolute foundation, the bedrock. It sets the rules. And this one, Metal, is built specifically for, compliance, handling scale, and letting institutions maintain control, sovereignty.
Okay, sovereignty, meaning control over their own space within the system.
Precisely. It lets regulated financial institutions, FIs, banks, credit unions launch their own private subnets, issue their own digital assets, all within a secure, auditable environment that follows U.S. rules.
But this isn't just theory, right? The sources mention actual adoption.
Yeah, this is interesting. More than a dozen credit unions are apparently in a stablecoin pilot right now on the Metal architecture, deploying their own branded deposit tokens.
Well, the report calls it a first in U.S. banking history.
Wow. Actual regulated banks issuing stablecoins on chain. That does anchor the whole L0 idea.
It shows it's working, attracting the very institutions it was designed for. Okay, so that's the secure compliant base layer, Metal. Now, moving up a level, pillar 4, XPR, the main layer 1 hub.
Right. So if Metal provides the, let's say, secure private roads and the rulebook, then XPR is the main highway. It's the interoperability layer of the whole Metal blockchain, the central hub.
So its job is movement, making things flow.
Basically, yeah. Making sure assets, whether they're institutional ones sitting in those private subnets or retail assets, can move smoothly between different subnets, different digital identities. It's the exchange and settlement layer.
And adoption. The numbers look big. Over 700,000 accounts mentioned.
It's cited as one of the fastest growing DeFi networks in the US. That's 700,000 number. It's accounts or wallets registered.
Right. Always the question with numbers like that. Is it active users or just registrations?
It's a fair question. The source emphasizes network expansion. So even if not all are active daily, that number shows distribution, significant reach.
And that growth. It connects back to Metal, doesn't it?
Absolutely. That layer 1 speed, the XPR expansion, it's only really possible because the layer 0, Metal, is handling the tricky compliance stuff underneath.
Okay. So the high trust environment from Metal enables the high speed on XPR.
You got it. L0 sets the rules. L1 handles the fast transfers. Okay, so that's the infrastructure. Now, shifting gears, let's talk about the actual money, the assets built on top. Starting with pillar 1, XMD, the Metal dollar. Right? The sources call XMD the heartbeat of the whole thing. And it's not your standard stablecoin just backed 1.1.
How so? It's described as a compliant, reserve-backed, multi-asset stablecoin index. Key phrase there. Index, and designed for institutions. Multi-asset stablecoin index. Okay, break that down simply for us. What does that actually mean?
Think of it less like holding one specific dollar coin and maybe more like holding a share in a really stable money market fund, an ETF maybe. It doesn't rely on just one bank account or one type of backing.
So it pools different things together.
Exactly. XMD bridges multiple regulated sources. So bank-issued stable coins, those credit union deposit tokens we talked about, and other USD-backed liquidity all into one transparent basket.
Okay, so you're spreading the risk, diversifying the backing across several regulated entities.
Yeah.
And it's transparent.
Precisely. Which lets XMD function as the main trading pair, the settlement asset across the whole Metal ecosystem, Metal L2, the digital banking network, TDBN. It's the internal currency.
Gotcha. The system's core unit for settlement.
Yeah.
So how is that unit then used for things like, lending? That brings us to pillar 5, loan, the lending protocol.
Right. Loan brings in the decentralized finance utility. It's described as a DAO, a decentralized credit marketplace.
A DAO, so community governed.
Yeah. And it powers compliant borrowing and lending, but self-custody. So you hold your own keys. It's taking DeFi functions like earning yield or borrowing against collateral
and plugging them into this regulated stack.
Exactly. It integrates by connecting XPR, the speed layer, with Metal X, which is their exchange, into one platform, basically creating ways to earn yield on-chain, but within the rules set by Metal.
Okay, so you have the institutional rails, Metal and XPR. You have the settlement index, XMD, and decentralized utility with loan.
Yeah.
That's a lot of moving parts. It is. And it raises that key question, how do you keep it all aligned? How do you govern this complex system with DeFi elements and institutional needs towards one compliant goal? And that, I assume, is where the last pillar fits in. Pillar 2, MTL, the governance core.
You nailed it. MTL is the glue, as you said earlier. It's the DAO that handles governance across every layer.
Every layer. So it ties together XMD, Metal L2, all the index tokens.
Everything. Its job is to connect the different groups, the community, the DAO voters, the institutional players under a single incentive structure.
So decentralized decision-making, but keeping the ship pointed towards compliance and the overall U.S.-built strategy. That's the tightrope walk, yeah. Balancing decentralization with the necessary controls for regulated partners. Okay, this is really interesting. We've laid out all 5 pillars: XMD, MTL, Metal, XPR, loan. Now the synthesis part. How do they actually form that unified system? The sources map them to the 4 functions of money. Yeah. This is where they claim the whole system becomes more than just parts. Yeah. It becomes a self-sustaining monetary framework. Let's see how. All right, first function, store of value. How does this ecosystem hold values securely? Well, the argument is the value is anchored by all 5 tokens working together. They collectively secure this portfolio, fiat, crypto, even commodities within the metal stack. So the trust isn't just in one token, it's in the whole governed, diversified system. Okay, makes sense. Next, unit of account. What are things measured in? This feels critical for usability. Right. And it's not just denominated in the native metal coins. This is key. It uses a multi-currency structure.
Yeah. Meaning it includes wrapped blue chips like XBTC, XETH, XDOGE. But also, importantly, those regulated stablecoins, USDC, USDP, PYUSD, and the credit union deposit tokens.
So if those credit unions are issuing their own stablecoins on metal,
those tokens become a native unit of account within their part of the network. The system essentially accepts multiple forms of compliant money.
Like an operating system for different types of regulated digital cash. Okay, how does it move? Method of payment.
This is about flexibility. Transactions can happen on-chain using XPR, Metal, L2 speed,
right,
but also, crucially, off-chain through Metal Pay, their app, and through the partner banks and credit unions using their private subnets.
So bridging the crypto world and traditional banking rails for payments, seamlessly, ideally.
That's the goal. Okay, final function, means of exchange. How do you trade value within the system? That's handled by MetalX, the exchange, and Metal Pay, the app, working together. They act as the bridge between the regulated side and the decentralized venues. Hayner's post actually used an analogy here.
Yeah, what was it?
He likened the whole integrated system to the Apple ecosystem of crypto.
The Apple ecosystem. That's provocative because Apple implies, a walled garden to some extent. Control.
It does.
How does that square with decentralization? If it's vertically integrated like Apple, doesn't that mean some level of central control over who gets in and the overall experience?
I think that points directly to the trade-off they're making. To guarantee that deep compliance that institutions need, you maybe do need that level of integration, that control over the whole stack, from L0 right up through governance and settlement.
So the primary goal isn't pure permissionless decentralization at the base layer.
It seems the goal is maximum compliant utility. It's about building a trusted environment for institutions, using blockchain for efficiency and transparency, but perhaps within a more controlled framework than, say, public Bitcoin or Ethereum at their core layers.
Okay, that context helps frame their whole philosophy.
Yeah.
Which ties into the network effect idea.
Absolutely. The sources bring up Metcalfe's law directly, network value growing exponentially with connections.
And what's driving those connections? What fuels the exponential growth here?
3 things, mainly. 1, the organic growth of the XPR network. That's the retail base, the 700K plus accounts. 2, the tech expansion, like launching Metal L2. And 3, probably the most impactful, is adding more institutional partners via the digital banking network. Each new credit union isn't just one new node. It's potentially thousands of users, new stable coins, new connections. That's where the exponential part kicks in.
It brings us back to that quote summarizing their approach.
Where others speculate, Metallicus builds. Where others fragment, Metallicus unifies.
And the foundation of that unification effort is compliance, always compliance. The branding is loud and clear. Born in the U.S., compliant by design, offering clarity and compliance in a world of noise. It's about de-risking it for institutions. So they're basically offering banks and credit unions a ready-made, regulated sandbox to step into digital assets without needing to build the whole L01 tech themselves.
That seems to be the core value proposition for FIs.
Okay, so we've covered the infrastructure, Metal, XPR, the assets, XMD, loan, the governance, MTL. We've seen how they aim to deliver this complete, compliant financial stack.
For both institutions and retail users, yeah.
So what does this all mean? Where does this leave us? The big picture implication seems to be less about disrupting banks and more about upgrading them.
Potentially, yes. The framework seems designed to give traditional institutions the tools to operate in this new digital, decentralized-ish world, allowing them to participate directly, not just get run over.
Right. Which leads us to that final thought for you, the listener, to chew on. Based on everything we've discussed, especially that emphasis on compliance and getting regulated players like credit unions to issue their own tokens, if those FI-issued stablecoins really take off and become a major unit of account and method of payment within this kind of compliant L0, L1 system, What does that do to the traditional role of a bank? Could we see a future where a bank's main product isn't really the old deposit account measured in government fiat, but rather a bank-issued digital asset defined by code running on these rails?
With the bank itself essentially acting as the regulated trust layer, managing the keys and the compliance around that digital asset.
Exactly. What does that imply for the future structure of banking itself? Something to think about.